Good morning, everyone. My name is Michael Naidrich, and I am the co-CEO of AmeriVet Securities, and I am pleased to be joined by my partner, Gregory Faranello, CFA, all things rates, Fed, and liquidity. Good morning, Greg. You know how much I enjoy this.
Good morning, Michael. How are you?
Everything's well, man. I hope you had a wonderful weekend. Look, this is an interesting meeting because there's a lot going on here. Not only are we at the July meeting, we're also at a situation where we don't come and meet again until September. So, what happens here and the words they say are really going to matter. So, let's jump right into it. Let's preview the meeting a little bit. We got the statement, we got the decision, we got the presser. We're hearing we're priced for 25. There's probably going to be some talk about a second 25 basis point move with the terminal peaking in November sometime. Let's jump into that for our clients and our folks.
Sure, you got it. And you said it best. I mean, we do have a big break between this meeting and September, and we did have the skip in June. So with the statement, look, I mean, I have the last statement in front of me. Job gains have been robust in recent months, unemployment low, which it still is, inflation remains elevated. They could tweak that. They could say inflation is moderated, job gains are still good, but have moderated. And then to the extent to which additional firming policy is needed, which was in May, to the extent of additional policy firming, they could tweak that a little bit too, to intimate that they potentially look to skip again at the September meeting. With regard to the decision, Mike, look, we're priced for 25, close to it, almost 100%. So they will deliver as priced. And we have a little bit of pricing, call it 40% for maybe an additional 25 basis points, which they intimated in their June summary of economic projections. We won't get one this week. We will get another one in September. There hasn't been a whole lot. I mean, inflation's coming down, but there hasn't been a whole lot in my mind to significantly change their stance that the potential for 2 rate hikes for the rest of 2023 remains on the table. So we do expect to hear that in some way, shape, or form from Powell in the presser. We think at a minimal, he will retain optionality, acknowledge the decline in inflation, acknowledge the labor market is still strong. But at the same time, we know the Fed is getting closer to the end game, and we do expect to hear an element of that as well in the press conference.
Yeah, I agree. And I think you're right. That word optionality is going to be front and center, I believe. So let's talk a little bit, Pal, about the financial conditionings. It's clear they've been loosening since the Fed March hiccup. Put it in some context. You got equities, you got rates, you got the US dollar, you got, investment grade, you got high yield. Is this the new Fed put?
Yeah, that's a good question. I have been calling a new Fed put out there in our recent writings. Look, October of 2022, clearly the bottom in equities. If you look at really risk assets across the board, that's when then Vice Chair Brainard started to talk about long and variable lags. And the market started to sense that the Fed was going to slow down and ultimately get to where they are right now. Now, we had that March hiccup, right? So we had the March hiccup. We know the Fed put that we normally know in terms of lowering interest rates in the balance sheet. We're moving the opposite direction now because of inflation. We're running the balance sheet off, call it QT, and obviously the Fed is still raising rates. So what is the new Fed put? The new Fed put, in my mind, are the 13.3 emergency lending facilities. So just like in 2008, where banks wouldn't lend to each other, the March hiccup, we saw uninsured deposits really lending to banks. I mean, deposits are really individuals and institutions lending to banks and saying, look, we're nervous now. We want to pull that back. The Fed came in and said, well, if they're going to pull their money out and they're not going to lend to you anymore, we'll lend in place of that, albeit at costly levels in terms of the pricing of OIS plus a spread, which is Fed funds plus a spread. So if you look at markets, really since March, Mike, we've done nothing but turn green, right? If you look at, we had the hiccup, we saw spreads widen, but if you look at high yield credit, if you look at IG, if you look at rates, if you look at equities, if you look at Bitcoin, if you look at the dollar weakening, financial conditions have done nothing but loosen. So that, to me, that's certainly something for the Fed to keep an eye on here. So relative to this meeting and going forward, we still think the Fed, although this may be the last rate hike, we still think the loosening of financial conditions and the potential for an extremely dovish message from the Fed will keep them on their toes in general. They don't want to send the wrong signal to markets until they're fully confident that inflation is heading down to 2%.
Yeah, so let's stay on that. And there's been some chatter out there about the Fed potentially changing their inflation target from 2%. What's your thoughts on this?
So that's a good one. And I love this question because, look, I'm of the mindset that the Fed is not going to formally change their inflation target. Now, there's a ton of chatter out there because, people are concerned in general. Investors are concerned that if the Fed fights this battle tooth and nail down to this minutia of 2%, they're going to drive the economy into a recession. Quick context here. I mean, Chairman Greenspan had this soft 2% target. He didn't really formalize it, but he was of the mindset that inflation year to year should come and go. We really shouldn't feel it. And then that 2% target was formalized by then Chairman Bernanke in 2012, other global central banks filling in. Look, I think the reality is this. Inflation is heading lower. The trend is clearly in place. Risk assets are embracing that fully. I think if we get down to 3% in inflation, that core number gets down to 3%. And at the same time, we see the economy weakening, potentially the labor market weakening. I think the balance of risks for the Fed at that point will shift more toward maximum employment and inflation. But right now, I still think the balance of risks is still in the camp of the Fed fighting inflation. So we're moving in the right direction. I don't think they formally changed their policy as they've gotten inflation wrong from 2021 into 2022. Now would not be the right time to do that, but that doesn't mean they won't have a soft change of stance if inflation continues to come down.
Totally understand that completely. Let's do some, let me throw some rapid fire stuff at you that maybe you can just touch on. I'd love for you to talk about the inverted yield curve. I'd love to talk to you, have you talk to us about recession signals. I'd like to please talk to us about higher for longer from the Fed, and then maybe potential rate cuts.
Okay. That's a lot. That is rapid fire.
There's a lot out there.
Let's get to it. Look, we've written about the yield curve for years on end. Our view on inverted yield curves is very simple. It is one tool that's used in the repertoire of signaling recession. It's not the only tool. And by the way, the timing is very suspect. So just because the yield curve goes inverted doesn't mean a recession is imminent. We saw this in 2019. We had an inverted curve. And then lo and behold, the pandemic hit. The curve wasn't predicting the pandemic, but everyone said, okay, see, the yield curve is a good predictor of recession. So, when you look at the yield curve in general, you look at the short end, it's dominated by different players, right? Money market funds, very active on the short end of the curve. If you look at 2 years and under, it is truly reflecting the funding levels of where the Fed has put the market. If you look further out the curve, the participants in that market are much different. You have insurance companies, pension funds that shift around their asset liability mix. So you do have a natural buyer further out the curve that is far different in nature than you see on the short end of the curve. The other thing, too, is longer end rates, in my opinion, are reflecting the fact that the market believes that the Fed is going to win with inflation. If you look at long-term inflation expectations, call it 10 years, we're in and around 2.25, which is right around the Fed's target. If you look at the long run neutral rate, not too hot, not too cold from the Fed, call it 250. Maybe it's a little more elevated in this environment, but I think the long end of the curve clearly here is signaling that the Fed ultimately is going to win on inflation. With regard for higher for longer, we love that theme. Certainly, this could be the last rate hike of this cycle, depending on how inflation evolves. And right now, it looks like it will continue to moderate. We love higher for longer. I mean, the Fed hasn't been historically able to keep rates that high for that long, but we also haven't seen an inflationary pocket like this in quite some time. So we like the Fed, the perma hold strategy, at least through 2023, but we've been in that camp really all along when the market was pricing in rate cuts. Cuts in 2024, middle of the year. I mean, there is nothing inappropriate with the market now saying that the funds rate could very well come down in 2024. The Fed's own forecast is for that rate to come down, and the market is saying will come down by roughly 100 basis points. The only thing I would say is if inflation does continue to come down, the Fed sees a need to lower that funds rate down to a more appropriate level. And keep in mind, as inflation comes down and that funds rate stays high, they are becoming more restrictive in that process. So if they do feel the need to come down, perhaps the market is underestimating how much they could come down from a 550 level down to 350. The speed at which that happens, we know in general, with the exception of this cycle, in general, the Fed is more bold when they lower rates than when they higher rates. And then I'm sorry, Mike, your last component there that you asked.
No, I guess maybe I'll take a different aspect of it. I know a lot of stuff there. I guess the question I have here is, and pardon, I guess my last question is on is maybe about a year ago, maybe a year ago plus, with the Fed talking about transitory inflation, with Powell and Yellen, and there was some really strong belief that they didn't have a control on things. I personally, and for those of you who follow along at home, when Greg was talking about people who thought they'd cut in mid-January, mid-2023, he was talking about me and others. But I think I think people think they might have control now, where they didn't for a long time. I'd love your thoughts on this.
So they've certainly played catch up. I mean, it's hard to argue from a rate perspective that the Fed hasn't moved the needle. They certainly have. And financial conditions have tightened. I'm not sending the wrong message, but I think it's important to see where financial conditions have tightened from. 2021, I call it an abyss, fiscal and monetary contributions. We had never seen financial conditions that loose. So yes, they have tightened, they have moved the needle. Do they have control? I mean, there's certainly an element of more capital requirements coming in. There's certainly an element of oversight, which with regard to the smaller banks in March, the Fed has been fairly forthright there. So there is some catch up to be done there. And I do think they are certainly playing catch up. And with regard to the issues out there, the risk factors, certainly inflation is a risk factor. I mean, the need for them to potentially go even higher than what the market is pricing, that's a risk factor more so than the Fed cutting rates. And then in general, when you look at reset risk too, do they have control? I mean, we know commercial real estate is lingering out there, residential real estate, we have ARMs that'll come to reset. We have a lot of treasury debt, corporate debt to roll over. So yes, they are in better control than they were in 2021. And I think that the case in point there, inflation expectations, like we talked about before, long-term inflation expectations are signaling that ultimately, with hiccups along the way, the Fed is going to win the battle on inflation.
That's great. And I'll tell you, Greg, I'm looking forward to Wednesday. I think, nothing's predetermined, but it does look like they're going to raise a quarter. But I'm really looking forward, like I always say, for you diving into, Chair Powell's press conference and, the presser and maybe some of the comments after. I think that's, probably your most unique value to our clients, and that you really not only put yourself out there before, but being able to analyze after and have a forward-moving thought on that. With that, look, we did this for a lot of years now. I look forward to hearing from you on Wednesday, and certainly maybe a well-deserved rest for you heading into the last couple of weeks of August for you and your family. So thank you so much. And for anyone who would like to speak to Greg, please let one of your client representatives know, and we'll be happy to get him in front of you. Thanks, Greg.